Good class, good morning. This is Attorney Lyndon Maceren, your host, your coach, your professor, instructor for Taxation 231. Welcome back. We are now in Chapter 3, this concept of income. We'll now start our discussion with the different types of income taxes. First, there is the Presumptive Income Tax. So in this system, or this type of income tax is imposed in relation to a group of persons, their actual expenditures, but the income is presumed. This happens when the taxpayer failed to file his income tax, or uh, filed but a wrong or fraudulent, say, understated income or understated sale. So the officers of the BIR or the examiners of the BIR will presume his income in order to get his presumptive income tax. And it will be based on the income of other taxpayers of the same class or the same group. No? For instance, this person is operating a hardware store. So normally, what is the income of a hardware of this size? So BIR examiner will presume his income in order to get his income tax. That's presumptive income tax. So the next one is composite income tax. This tax consisting of a series of separate quasi-personal taxes. So a person's tax, a person's income is given separate personal taxes. And then the particular source of income with a superimposed personal tax on the income as a whole. So the overall income will be, there will be an imposed personal tax. So that's the composite income tax. The other type is unitary income tax. This is where incomes are arranged according to source. So if it's compensation, that's one source. If it's business, that's another source. And if it's obtained from the exercise of profession, so that's another source. So there are three sources. Now the separate items, the separate compensation or earnings shall be added together. Then a rate will be applied to all of them, thus resulting to a total income. So that's a unitary income tax. We does that here in the Philippines. Okay, another system of, there are two systems of income taxation. The first one is the global system. This is where the tax system views indifferently. The taxpayers where taxes are generally treated in common all categories of taxable income of the individual. It is a system which taxes all categories of income except certain passive income and capital gains. Why? Because this income, passive income and capital gains, are subjected to final tax. So it's no longer reported in the income tax. So it prescribes a unitary but progressive rate for taxable aggregate income and flat rates for certain passive incomes derived by individuals. So under the system, there is a unitary or single tax rate. There is no need for classification as all taxpayers are subjected or subject to a single rate, and this system is usually applied to corporations. So before, in the first half of 2020, from January 1 to June 30, the corporation's tax rate is 30%. because 30%. But with the new Trabajo law, which is the second installment of the train law, another tax rate to corporations effective July 1, 2020 is being imposed, and that is only 25%. So a 5% reduction is enjoyed now by corporations. And that will be good until 2023 because starting 2023, the corporation rate shall reduce 1% every year until it reaches 20%. Okay, the other system is the scheduler system. So under the system, the income tax treatment varies and is made to depend on the kind or category of taxable income of the taxpayer. It is a system which itemizes the different incomes and provides for varied percentage of taxes to be supplied thereto. So just like in my example, if like me, for instance, I am earning compensation from companies. I have two companies. I'm working with two companies now. One of them is CITU. So I receive compensation income. And I am also practicing my profession as a lawyer. So I have income as a lawyer or a CPA or a real estate broker. I have commissions. And then I also have a business. No? I have a apartment. I have so many apartments. So I have earnings from my business. So therefore, I have three different kinds of taxable income. But my income, once they are added together, is subjected to the different tax rates, different categories of taxable income. So this system is such schedular system. So this system, according to the author, is usually used in income taxation of individuals, the schedular system. Okay, for our present income tax system that we are now using, it features progressive, which means that the tax rate is graduated, and that is from 5% to 32%, no, 10% to 32%. So progressive meaning the ability to pay. So when a taxpayer earns less, he is subjected to a low tax rate. If a taxpayer earns more, then he's subjected to higher tax rate. That's progressive, the ability to pay. And we also have the global system, and that is for tax corporations, and schedular system for individuals. So individuals are persons. No? Then we use the gross compensation system of income taxation. So compensation, meaning a person is earning salary and or wages, so no other income. So if you are an employee and you're receiving a salary of 50,000 a month, the system that is your income tax system is using the gross compensation system, meaning you are not allowed to deduct any expenses. So no deductions allowed, including your personal exemptions and additional exemptions. So no more. So no more personal exemptions, no more additional exemptions. So that's gross, no deductions, okay? Of course, there are exemptions. Then the income taxes under the National Internal Revenue Code. This is National Internal Revenue Code. And the train law, which is now the new tax law. Because the some NRC cannot be discarded because some of the provisions of the tax of this code is still enforced, no? So it still remained. So income taxes under NRC and the train law are the tax on individuals, meaning the persons, then the tax on corporations, including partnerships, no? And joint ventures, then income on estates. Estates, again, is created when a person or taxpayer dies. And he's now, when a taxpayer dies, he becomes his title becomes dissident, no? And he left a business or he left property which is income generating. Let's say a person dies, taxpayer dies, and he has a coffee shop. So his property is earning. So the taxpayer will become, his property will become an estate. So in case that person is Juan de la Cruz, then the taxpayer will be the estate of Juan de la Cruz. Okay. So there are also trusts, which are also another taxpayer. So trust happens when a person is giving the income or giving his property to another person, no, but not yet as of the moment. Why? Because probably the person is still a minor. So that minor is the trust beneficiary. So now, for example, I am the trustor. So I'm going to the US because I'm going to retire there. No, retire ako dito. And I have businesses here in the Philippines. And instead of running the business here, because I'm going away, then I'm leaving it to a trustee. So the trustee is the person that I given the authority to run my business in favor of the trust beneficiary of my son, who is still a minor. So whatever the income of the estate, about properties in the trust, will be subjected to income tax. No, that's the trust. It is a contract, and the parties involved is the trustor, the trustee, and the beneficiary. Okay, who is a taxpayer? A taxpayer is a person or any person subject to tax imposed by the tax code. Income taxpayers are persons who derive taxable income. So once you have a work, or once you have a job, or you have a business, or you're generating income, so you'll become a taxpayer. Now, there are classifications of taxpayers. So first, the individual taxpayers. These are persons. Then we have corporate taxpayers, includes partnerships or co-partnerships. Then estates under juridical settlement. So I already explained that. And trusts, irrevocable, both as to corpus and income. And then we have the GPP, the General Professional Partnership. These general professional partnerships are partnership among professionals. No? Let's say you're already a lawyer and or a CPA. You're already a CPA, and all of you will agree that you'll form a firm, no? So a firm of CPAs conducting audits and other kinds of functions. So you're forming now a partnership, and that partnership is called GPP, purely to exercise your profession as accountants. Okay, but you cannot be uh, you cannot have a partnership with a doctor because the doctor has a different profession. So GPP should have one kind of profession. Or you can be lawyers and at the same time CPAs, no? All of you must be lawyers, CPA lawyer. Not only one lawyer, then all of you are CPAs. That cannot be, no? Oh, it can be, but only for accounting, not for lawyering, okay? All right, the different kinds of individuals. So number one, individual taxpayers. There are different kinds of individuals. So the first kind are those citizens, no? What do you mean these citizens? These are the residents, these are the Filipino citizens. And citizens, there are two. So for citizens, they are taxable on all income derived from sources within and without the Philippines. What do you mean by without? Without means outside the Philippines, no? So citizens are subjected to income tax for earnings or income within, so meaning in the Philippines, and without, meaning outside the Philippines. Yeah? And there are two types of citizens. Now, there are three types of citizens. The first are the resident citizens. So these are Filipino citizens who are residing here in the Philippines. So for this kind of taxpayer, he is taxable on all income derived from sources within and without the Philippines. So if he has a business which is operating in the US, so all of his income there shall be subjected to income tax here in the Philippines, because all income, no? So whether outside the Philippines or inside the Philippines. Another citizen is the resident or the non-resident citizen, non-resident. So he's a Filipino citizen but residing in the US. So is he subjected to tax for his income in the US? The answer is no. He cannot be subjected to income tax for his income in the US because he's non-resident. According to this definition, he has only taxable or description is only taxable on all income derived from sources within. So only within the Philippines or inside the Philippines, but not outside. No? That's a non-resident Filipino citizen. And then we have the overseas contract worker. These are Filipinos, still Filipinos, but working and deriving income from abroad or a foreign country. Are they taxable for their income outside the Philippines? The answer is no. They're only taxable within the Philippines. So only income which are earned here in the Philippines. Let's say I am an OFW. I'm working in UK, no, as a lawyer. But here in the Philippines, I have apartments. I have a business here, or I have a coffee shop. And I am not subjected to income tax for my work in UK as an overseas contract worker. It should be contract, not contract worker. Sorry for the wrong spelling. But I am only taxable for my income here in the Philippines, which is from my apartment and my coffee shop. Okay. So overseas contract workers are not subjected to tax for their income abroad. Another kind of individual are aliens. Who are aliens? These are foreigners, no? So are they taxed here in the Philippines? Yes, only for income derived here in the Philippines. So within the Philippines. For their income outside the Philippines, they're not taxed because the Philippines has no jurisdiction. No? So there are three types of aliens. Resident aliens, meaning a foreigner who is already a resident here in the Philippines. And then we have non-resident aliens engaged in trade or business. So he is an alien, but he's also a non-resident. So he has no residence here in the Philippines, but he is engaged in trade or business. And then we have non-resident aliens not engaged in trade or business. This is NETV. NETV. Non-resident aliens not engaged in trade or business. Still, this type of alien is still subjected to income tax for sources within the Philippines. Right, for tax purposes, corporations are classified into the following: domestic corporations and foreign corporations. So domestic corporations are those which are registered here in the Philippines. They are only taxable. They are taxable on all income derived from sources within and without. So both, no, inside the Philippines taxed, outside the Philippines also taxed. So for foreign corporations, which are these are corporations registered in a different country, they are only taxable for income here, for income which are earned here in the Philippines. So only income derived here in the Philippines, sources within. So there are two types of foreign corporation. One engaged in trade or business, just like here, engaged in trade or business, and not engaged in trade or business, or NETV. Yeah. NETV, this one engaged in trade or business, so ETV. So further, we will classify the different kinds of Filipino citizens for tax purposes. Resident, first kind will be resident citizens. These are Filipinos residing in the Philippines. For non-resident citizens, these are those who establishes to the satisfaction of the CIR or the Commissioner of Internal Revenue the fact of his physical presence abroad with a definite intention to reside abroad. No? So he will reside abroad. He shall submit proof of to the CIR. So again, CIR is Commissioner of Internal Revenue, to show his intention leaving the Philippines to reside permanently abroad and to return to and reside in the Philippines as the case may be. So an immigrant, so non-resident citizens are classified further into immigrants. This is one who leaves the Philippines to reside abroad as an immigrant, which a foreign visa is issued to him. So he will work there permanently, or as an immigrant. So he becomes a citizen of, also a citizen, or no, green card holder probably. No? Now we are, we have the double citizenship or dual citizenship. No? If you are an immigrant in the US, then after residing there for a quite long length of time, you can obtain a citizenship. So you become an American citizen. But we have dual citizenship. So at the same time, as long as you do not relinquish your Philippine citizenship, you still retain or you still remain as a Filipino citizen. Then there are non-resident citizens who are permanent employees. So these are one who leave the Philippines on account of a contract of employment. So this is OCW. Oh, no, no, this one is permanent. Yeah, still OCW. Then we have contract worker, one who lives in the Philippines on account of contract or employment, which is renewed from time to time within or during the taxable period under such circumstances as to require him to be physically present abroad most of the time during the taxable year. A contract worker must have been outside the Philippines for not less than 183 days. So remember this, if a Filipino is away from the Philippines for more than for at least 183 days, no, outside the Philippines, then he is classified as a non-resident citizen because there are 365 days in a year. So if you divide it by that by 2, it will result to 182 and a half days. No, that's one half. So more than one half is 183 days. So the Filipino should stay abroad 183 days and he can be classified as a non-resident citizen. Okay. On the other hand, aliens, there are two types, resident aliens. These are non-Filipinos but residing permanently here in the Philippines. They are placed in the same category as citizens of the Philippines. Then there is a non-resident alien. He's non-Filipino and either do not reside here in the Philippines or temporary residence here. So he's not a resident. All right. On the right of the government to tax income, this emanates from its partnership in the production of income by providing the protection, resources, incentives, and proper climate for such production. So this is the reason why the government has the right to collect income tax. So this emanates from the theory of benefit protection theory, which is also known as the necessity theory. Okay. All right. Now let's go to the main topic, which is income. So we define income. It is the all wealth which flows into the taxpayer and is not a mere return on capital. So it's not a return on capital, return of capital. Remember this one. It is not a return of capital. Because if it is a return on capital, that is already an income, no? If you change of to on, it becomes an income. Income is also defined as an amount of money coming to a person or corporation within a specified time, whether as payment for services, interest, or profit from investment. Otherwise, unless otherwise specified, it means cash or its equivalent. And then we have another definition for purposes of solving income taxation problems which require the determination of items considered as income. Another definition, income is defined as any material gain, not excluded by law, realized as out of closed and completed transaction. So the transaction must be closed and completed, where there is an exchange of economic growth, economic value for another economic value. So there's an exchange. So if the construction is completed, there's an exchange. So like in a sale, let's say I'm the buyer, I will give you the money. And if you're the seller, you will give me the property. So there's an exchange of economic value. So this definition should not be used for answering objective type questions asking for definition of income. Right, income also is defined as the all wealth which flows into the, this is already the same kind of definition, means all wealth that flows into taxpayer other than a mere return of capital It includes forms of profits, income specifically described as derived from sale or other disposition of capital assets. No? So, baligya. Kag imuang capital assets. Capital assets, by the way, are those assets which are not used in your business. It's capital assets. All right, let's go to the requisites. When is an income taxable? All right. Now, for income to be taxable, the first requisite is that there must be gain or profit. No? And second, the gain must be realized or received. And then okay, and then thirdly, the gain must not be excluded by law or treaty from taxation. Let's discuss these requisites one by one. So the first one is there must be gain or profit. So in income, whether in cash or its equivalent, because income does not only refer to money, a taxpayer, but to a money to taxpayer received, but it includes anything of value, whether tangible or intangible. So something valuable, no? So an illustration here, Mac bought a car for 1 million 3 years ago. So then Mac sold it for 700,000 pesos. With its accumulated depreciation already, 400,000 pesos. So question, how much is Mac's gain on sale? All right. So according to the solution, the gain is 100,000 pesos. Yeah. 100,000 pesos. That's the gain on sale. It's not 1 million minus 700. No, it is. No, it's not. I mean, it's not 1 million minus 700 or a loss of 300,000. Diba? You will say, hey, it's a loss. There's no gain. There's a loss. But in actuality, in taxation, you will get the value of the car by deducting its cost, the accumulated depreciation. So that's the value. So the book value of the car is 600 pesos, 600,000 pesos, because this is in 000 or in thousands. So purchased the car 3 years ago for 1 million. Then there's accumulated depreciation, meaning the depreciation is accumulated every year for 3 years, and it is 400,000 pesos. So you deduct that. So the book value of the car is 600,000 pesos. So the selling price is 700 minus 600. So there is a gain. And the gain is 100,000 pesos. No? It's not 1 million minus 700 or a loss of 300,000. But this is the way to compute it using the deducting book value of the car from the selling price. So there is a gain here. And is he subject to income tax? Yes. No? 100,000 pesos will be subjected to income tax. Okay. Another requisite is that the gain must be realized or received. Even if the material gain is not excluded by law, if the material gain is not yet realized by the taxpayer, so there is no income yet. If it is not yet realized. Hence, mere increase in the value of property is not income, but merely an unrealized increase in capital. So all right. So increase in value of property is not income. Then mere increase in net worth of a taxpayer, which was not the result of receipt, but it is uh, according was merely the outcome of correctional errors. So there were errors in the books relating to indebtedness to certain creditors, which have been overstated. So the debt, ang utang or liabilities has been overstated. So upon correction, there's like a gain. So, but according to this definition, it is not a gain because it's just a correction of the error. Or if there's a listed outstanding debt, tunay utang, pero in actuality there has been none because it has already been paid. So this does not give rise to taxable income. So this is just erroneous. So in this case, there is no gain realized or received. So this is under the principle of realization or the doctrine of actual receipt. So under this principle, the revenue is generally recognized when both of the followings are met. So revenue is only generalized when meeting these conditions. And what are these conditions? Firstly, the earning process is complete or actually complete. So there's a transaction and payment was already received. So that's a complete transaction. And secondly, the exchange has taken place. So if the buyer has already paid and the seller has already surrendered the property, then there's exchange of properties. So these are the two requisites in the realization principle. So the principle requires that revenues must be earned before it is recorded. All right, to illustrate, we have cases here. Case 1, M Corporation is a real estate lessor, meaning is lessing properties to lessee. So in 2020, in the year 2020, it collected rent of 300,000 pesos. And this collection is coming from the years 2019 and 2018. No? So question, how much should be the rent income reported in 2018 and 2019 and 2020? So the answer is here, only for 2020, Mr. M Corporation will report the 300,000 rent income which has been collected. No? So only in the year 2020, but none for the years 2018 and 2019. So a lot. Why? Because in lessing, the taxpayer can exercise the cash basis way of taxation. No, the way of the reporting. That's cash basis. We will go further that. Okay, another illustration. Lam purchased a condo unit for 3 million in the year 2016. So palit siya condo. In the year 2017 or the year after, the said condo unit has a value already of 3.5 million. Probably because the building has been completed, no? And in 2016, not yet pa, still undergoing construction. So the value of the property went up or higher, 3.5. Now in the year 2018, Lam sold it for 3.7 million pesos. So question, should Lam declare income in 2017 when the condo unit was valued already at 3.5? Was there an income? The answer is no. Why? Because there is no exchange of money yet. and the value or the increase in the value of the said condo has not yet been realized. No, there's no, under the realization principle, it has not yet been realized, and there is no completed transaction, and there is no exchange of values. Okay. Question 2. When is there realization of income and how much? So the answer is in the year 2018. And that is when the condo unit was sold. And how much is the income? The income is 700,000 pesos. That's deducting sale proceeds or the selling price of 3.7 million minus 3 million. No? Here, 3.7 million minus 3 million. So the difference is the income, and that's 700,000 pesos. So it can be reported only in the year 2018. So under the doctrine of constructive receipt of income, income is considered constructively received where the taxpayer has an unjustified right to receive the same, but by his own choice, the income is not reduced to his possession. So if like for example, so according to this definition, the taxpayer has already a right to receive, but then for unjustified reason, he chooses not to receive the payment or the the item in his possession. So examples: undistributed share in the profits of a partner in a GPP. Again, what's a GPP? It's General Professional Partnership. Now, if the profit of the general GPP, because a GPP is not a tax-paying outfit, no, it does not pay taxes. It does not file income tax. So again, GPP does not file income tax return, but only the partners in a GPP. So there's already a profit, but it's not yet distributed. So in this case, the partner is already bound to file income taxes, the partners in the GPP, but because it's not yet distributed, then it falls under the constructive receipt theory or doctrine. No? Then there's another one, uncollected matured interest coupons, which are already due and payable. So it is income for the year during which the coupons matured. So these are coupons. No? Then credited interest collected on savings bank deposits. Of course, the interest of your deposits in the bank are just credited in your bank deposits. It's not yet received actually, but it is already constructively received. Then dividends applied by the corporation against the indebtedness of a taxpayer, of a stockholder. So there's a stockholder, but he owes the corporation. So instead of paying, and since there is declaration of dividends by the corporation, then the stockholder and the corporation agreed that they will compensate the indebtedness against the dividends. So compensate. Compensation is set off, no? So therefore, the stockholders' liability to the corporation is already offsetted or extinguished by way of dividends. So this is constructive receipt, no? Receipt of income. Even though it's not actually received, but there is already, it is constructively received. Another example, rental payments refused by the lessor. So the lessor refuses to receive. When the lessee tendered payment and the lessee made a judicial deposit of the rental due. So in this case, the lessee chooses to deposit his payment in the court because there's a judicial deposit, no? And that judicial deposit is known as consignation. This is discussed in Law 1 or Law 231. So as if theory of income constructively received is designed to prevent a cash basis. So I already said cash basis a while ago, which delay reporting of income. So it also presumes the existence of income on transactions supposedly not subject to tax, like real property sold at a loss, because real properties are automatically subjected to 6% capital gains tax. And the basis would be the selling price, or in case of loss, the zonal value of the property or the fair market value, whichever is higher. By the way, the zonal value is provided for by the Department of Finance, which is provided or under the recommendation of the CIR. No, that's one of his powers to assess or to give zonal values of properties within his jurisdiction. Okay. And the third requisite for income to be taxable is that the gain of the transaction must not be excluded by law or treaty from taxation. Again, law is by decree or pronunciation of our Congress, approved by the President. Then treaty is an agreement between nations or among nations. No? So this implied that not all income is required to be included because they are excluded by law or excluded by treaty. Like, for example, passive incomes of individuals like interest on bank deposits are not reported for income tax because this tax is already subjected to the final tax on passive income. Oh. But there are also other kinds of income which are excluded by law, like the bonus or 13th month pay. No? When your 13th month pay does not exceed the threshold of 90,000 pesos, so your, let's say, 13th month pay is only 80,000 pesos. So that gain is excluded by law. So it's not, there's no need to include that in your gross income. Okay, let's discuss the net worth formula in computing income, because income is actually an increase in the individual's net worth. So how do you compute net worth? Net worth is equal to total assets minus total liabilities. So total assets minus total liabilities. To determine the net worth, here's the formula. Yeah. So ending balance of your net worth and minus beginning, this gives you the increase or decrease in net worth. Then you add non-deductible items, you add back, then you deduct those which are non-taxable items. So this gives you the net taxable income. for the year. So net taxable income can be computed by the net worth formula. So there is an illustration here. Mr. Powell, or C. Powell, a sole proprietor. You know what's a sole proprietor? Sole proprietor is a person who owns a business. Sole, meaning solely, so singularly. So Mr. C. Powell reported the following during taxable year in thousands. So if you see 300, this means 300,000. If you see 800, this means 800,000. Okay, total assets in the year 2018 is 300, and in year 2018 is 800. Total assets in 2018 is 250,000, while in 2019 is 200,000. So there's a decrease in his liability. Then he made additional investments, or he invested more money, 100,000. So this increased the assets because he had added more money or asked property. Then he withdrew money, 100,000 in the year 2018, and in 2019, 230,000. Then there was a gain on the process of life insurance received of 150,000 pesos. Then unrealized loss or debt securities deducted, which is 20,000 pesos. So question, how much is CPAL's taxable income for 2019 using the net worth formula? Do you know how to compute that? Okay. Of course, how much is the net worth or net worth of Mr. CPAL, his ending balance? So the ending balance is 2019 and the beginning balance is 2018. So his net worth in 2019 ending balance is 800,000 minus 200,000 pesos, so 600,000 pesos, no? 800 minus liabilities, because net worth is assets minus liabilities, give you 600,000 pesos. But you have to add again his drawings because he deducted drawings, so you have to add this back. So 600,000 plus 230,000 is 830,000. Then you have to deduct the investments he made. So 830,000 minus 100,000 gives you 730,000. So that's his net worth for 2019. And you add back, which are non-taxable items or non-deductible items, you add back, and then you minus the non-taxable items. So which one is non-deductible here? So unrealized loss is non-deductible, so 20,000 is added. And gain on proceeds of life insurance received is non-taxable because this is life insurance, non-taxable, so this is deducted. Okay, we'll show now the solution. So the net worth after drawing an investment is 830,000. No, is 730,000. So that's what I told you. 600,000 minus the add the drawings, then you minus the investment. This is the total. This is the assets minus liabilities, and you get 730,000. For 2018, his net worth is 50,000 pesos. No, the beginning balance. See, the beginning balance is 300 minus 250,000. or 50,000 net worth. Then you add back his drawings, give you 150. So you add that to the net worth, gives you increase in net worth of 580,000. Deduct the non-deductible items, which is the loss. And then you minus the non-taxable items, which is the gain in life insurance. And the answer is 450,000 pesos. Now, using the net worth formula, you can arrive at the net taxable income. Okay. We have another example. BC Corporation reported the following during taxable year. So this is in thousands. So meaning this is 20,000, 80,000, 150,000, 60,000, and 30,000. So this is known as the effect of the assets, no? So increase in cash, what's the effect? So it increases the assets. Decrease in accounts receivable. So when your accounts receivable decreases, your assets also decreases. So this is deducted. The increase in investment, of course, it increases your assets. So this is added. Then increase in accounts, decrease in accounts payable. So this one result to the net worth is increase in the net worth, no? Because this is accounts payable. So it increases the net worth. Then increase in notes payable. So it's a liability, therefore it decreases the net worth. So these are, so there's another information here. During the year, BC issued 1,000 shares at 100 pesos per share to several stockholders and paid dividend amounting to 80,000 pesos. So question, how much is BC's corporation's income during the year? So using the net worth formula, you just consider the effect of this to the net worth. So I've stated that already. This one increases, this one decreases the net worth, increases the net worth, increases the net worth, then decreases the net worth. How about the issuance of shares to stockholders? What is the effect to net worth? Of course, it decreases, so it should be added back. And, oh no, this is an investment, so it increases, so this should be deducted. How about the dividends paid? So this payment, so this should be added back, no? So this is the solution. So effect in the net worth or the net assets, increase in cash, 20, deducted, decrease in accounts receivable, then added, increase in inventory, added, decrease in accounts payable. So the total increase in net worth is 120,000. And dividends are paid, so it is added back. And proceeds from sale of capital stock, this is good as investment, so this is deducted. You get the net taxable income. That is 100,000 pesos. So that's the taxable income of the corporation. Okay, we go down to the different kinds of distinctions. Capital is distinguished from income. A capital is a fund or property existent at one distinct point. Therefore, it is not an income. So there are four distinctions. Capital is a fund, while income is the flow. Capital is the fund of property existing at the time, while income is the service rendered by that capital. Income is the flow of services rendered by that capital. And this is by payment of money from it, or any other benefit rendered by a fund or capital in relation to such fund through a period of time. Another distinction, capital is the wealth itself, while income is the service of wealth. And the last distinction, capital is the tree, while income is the fruit. Okay. Another term, receipt. We will distinguish receipt from income. Receipt has reference to all wealth that flow into the taxpayer, which includes the return of capital. Thus, receipt is broader in scope than income. So receipt is broader in scope than income. Example, when a vendor or seller buys a welding machine for 10,000 pesos, so mamiligyan na siya welding machine, ipalit siya 10,000. Then he sold the machine for 15,000 pesos, meaning this vendor is a trader, no? This is not a vendor, but trader. So he sold the welding machine for 15,000 pesos. Therefore, the receipt can be broken down as follows. So cash receipt is 15,000 pesos, and cash receipt includes the cost of goods sold, which is 10,000, which is the capital, and the income of 5,000 pesos. So therefore, receipt is broader than income because it includes the capital and income, no? While income is only purely income, does not include capital. So we will now distinguish revenue versus income. Revenue is applied to taxation. This refers to all funds derived by the government, whether by taxes, donation, grants, or other sources. So revenue refers to the government, while income refers to earnings of individuals, partnerships, corporations, or trusts, whether subject to tax or not. No? So income is a term used by individuals, partnerships, corporations, while revenue is a term used by the government. Then we now differentiate taxable income versus non-taxable income. So there should be an income here. Taxable income versus non-taxable income. So generally, income from all sources that flows to the taxpayer is taxable. This should be a taxpayer. Sorry for the confusion. So all income that flows to the taxpayer is taxable. But it can only be non-taxable once it is exempted by law or treaty. So if there's a law exempting the income, like what I've said, the 13th month pay or treaty, no, then the income becomes non-taxable. So taxable income must be shown in the tax return unless it is subjected to final withholding tax, like interest or capital gains tax. So a taxpayer earning non-taxable income is not needed to be shown in the income tax return. This does not make sense. A taxpayer earning, which is non-taxable income, it's not needed to be shown in the need not file a tax return. Okay, like minimum wage earners need not file a tax return. Pure compensation earners of not more than 250,000 pesos, because this kind of earners have already been exempted by the new law, the train law. No? Not really exempted, but the deductions like personal deductions and uh, personal exemptions, additional exemptions has been upgraded to 250,000. So meaning if you are earning compensation of not more than 250,000, it is already excluded. And taxable income is synonymous to net income, which is gross income minus statutory deductions. Taxable income is the base upon which the prescribed tax rate is applied to get the amount of income tax payable. Okay, now we classify the different kinds of income. First, compensation income. This is the gain derived by labor, specifically from employment, such as salaries, wages, and commissions. Now, if you work in a call center, receiving money, so the salary you receive there is compensation income. So compensation here is different from the set off, no? Which is a mode of extinguishing obligation. This is the salary. It's a different term. Then we have another income, which is exercise of profession, like a dentist. If he is exercising his dentistry, then he's a professional. In the income he earned there is professional income. Or business income. This is derived from his business or utilization of capital, including profit or gain derived from sale or conversion of assets. Example, net income from business or gain from sale of properties used in business. In case of income arising from sales, business income or gross profit is equal to sales minus sales returns, sales allowance, discounts, and cost of sale. So this sentence here gives you the formula in computing gross profit or gross income when a taxpayer has a business. So again, gross income is computed by sales minus sales returns, allowances, discounts, and cost of sales. In case of income from practice of profession or receipts from rent and services, so a taxpayer is a practicing lawyer, for instance, or he has business from rent or from services. Let's say he is a masu, or if he is a singer, professional singer, so his singing prowess will give him income. So that's services. Or he's an actor. No? So business income or gross profit is determined by getting the gross receipts minus returns, allowances, and discounts. So there's no sale, there's no sales return, but only returns, allowances, and discounts, and no cost of sale. No? So this gives you the gross income. And then we have another classification of income, which is the passive income. So here the taxpayer merely waits for the amount of income to come in. No? What lang? Like royalties. When is royalty earned? These are composers of songs. So like John Lennon and Paul McCartney, they too have written more songs than any composers. No? They're the one who comprised the Beatles, John Lennon and Paul McCartney. there were other two, George Harrison and Ringo Starr, but they too, the two of them, John Lennon and McCartney, are they have composed more songs than anybody, and their songs have been sung by other singers. No, so once other singers or other performers would make a remake of their songs, and they get royalty. Okay, or when their songs are used as theme songs for movies, they get royalty. Then interest. If you have money in the bank, you earn interest. If you have invested for bonds, coupons, then interest. Then prizes and winnings. If you bet in the lottery, it is now subjected to final tax of 20%. No, before it is not, but under the train law, it is now subject to tax, and that is 20%. So if you win the jackpot prize of 500 million, it will be subjected to 20%, and that is 100 million. No, 20% of 500 million is 100 million. That's a big money, a lot of money. And we have capital gains. What is a capital gain? This is an income derived from the sale of assets, not used in trade or business. So for example, you are selling the family home. So you have a family home and you're selling it. So family home is not used for business. So there's capital gain, even though the sale is very low. Automatically, it's presumed as you have a gain. No? Or other assets, capital assets. Like you have a car which is not used for business. If you sell that, then that is capital gain. Okay. It's subjected to capital gains tax. So not all classification of income could be earned by a taxable person at the same taxable year. So passive income and capital gains are generally subjected to final taxes. So when they are subjected to final taxes, hence they are no longer required to be reported in the annual income tax return. Okay, let's go to the different sources of income. The first one are income within the Philippines, such as interest on bonds, notes, deposits, and the like here in the Philippines. Then dividends from domestic corporations. Then compensation for services or labor in the Philippines. The rentals of properties in the Philippines, and royalties from copyrights, patent, right to use scientific equipment, technical device, use of film, tapes, etc. in the Philippines. So these are royalties, no? Copyrights. So if you are an author also, author of a book, and your book now becomes a movie, you earn royalties. Royalty. Patent is invention, right to use scientific equipment, and others. No? Then gain and sale of real property, as well as personal property located here in the Philippines. So to compute income, there are rules to follow. Number one, if income in the Philippines is taxable only within the Philippines. Rule two, if service or labor income is earned partly within and partly outside the Philippines, and no accurate allocation can be made, the following formula is used. No? Say you are an international star, international singer. You sing here in the Philippines, you sing outside the Philippines. Again, you come back to the Philippines, sing again outside the Philippines. So in that case, you earn services partly within and outside the Philippines. How do you compute your income in within? then UR. This is the formula. Number of days labor performed here in the Philippines and divided by the number of days of labor performed, the total in a year, no? In a year, times the compensation received for the whole year. So this is for the whole year. Okay. So to illustrate, if Mr. F is a non-resident Filipino, so meaning he's a Filipino citizen, but he does not reside here anymore. He always goes outside the country for more than 183 days a year. So Mr. F reported 12 million as total income in 2019 for being an international speaker. Posing income, international speaker. And these are his earnings. No? In January, he spoke for 6 days, and that was in the Philippines. In March, he spoke for 3 days in Japan. In June, he spoke for 4 days in Taiwan. In the month of August, he was in the US for 10 days. In October, he was in China for 3 days. And back again the Philippines in the December for 4 days. So based on the facts given, how much should Mr. F's income be reported for the year 2019 as obtained here in the Philippines? So how would you compute that? No? So based on the formula given, it's number of days labor in the Philippines and divided by the total days labor in the year. So what's the total days here? It's 30, no? 6 plus 3 plus 4 plus 10 plus 3 plus 4 is 30 days. So if you add all the days here in the Philippines is 6 and 4. 6 and 4. That gives you 10 days. So 10 days divided by 30 days equals, or 1/3, 10 over 3, or 1/3, and times the total income of the year. It's 12 million. So what is 1/3 of 12 million is equals to 4 million. So the answer is 4 million in the Philippines. Yeah, answer is 4 million, computed as follows: 6 plus 4 divided by 30 times 12 months. 12 million pesos. All right.